one primary reason why we didn't have a recession last year is that the world of the past 30 years has changed a bit. Peak globalization. Think about a world where a smartphone, an iPhone, is designed by Apple, sent all over the world for construction, final construction in China, back to the United States. That world changed. And if you think about that world of how we've come to have a supercomputer in our pocket for $600, when if we all walked into a Radio Shack retailer, I don't know if anybody remembers Radio Shack from the 1990s, but if you would have walked into a Radio Shack in 1995 and wanted to purchase everything that is on our smartphone today, probably would have cost $10,000 to $15,000. Today, we get all of it for $600. That's the world of peak globalization, designed in the U.S., sent all over the world. But along the way, American labor was disenfranchised during that 30-year run of what we'll call peak globalization. The world changed a bit. 2016, there was a trade war. We had the pandemic. If you're running a country, there's not enough ventilators, not enough rubber gloves in your hospitals, can you ever go back to an overstretched global supply chain? I think the answer to that is absolutely not. Supply chains are consolidating. Russia invades Ukraine. Half of the world isn't condemning the action because half of the world needs Russian energy resources. That half of the world that used to be buyers of U.S. treasuries, they're not buying U.S. treasuries anymore, and they're actually trying to find a solution relative to the U.S. dollar. You add it all up, and where this means and how this comes back to why we didn't get a recession last year is that the global supply chain, where it was one big global supply chain, just stretched to the absolute limit, it's all coming back. It's all consolidating. One of the best performing emerging markets last year was Mexico because supply chains are coming back home. Just big consolidation. And with that of supply chains, you have a lot of investment happening in the U.S., a lot of construction of manufacturing plants, construction of semiconductor plants here in the United States. As the world sits right now, Taiwan makes 80, 90% of the world's semiconductors, but there's uncertainty. There's geopolitical tension. China, Taiwan, will the U.S. back Taiwan if China wants to take Taiwan back into the fold? Geopolitical risk is another reason for consolidation of supply chains. But if you think about things that have happened in Washington, D.C., there was the CHIPS Act, the Inflation Reduction Act, the Infrastructure Act, big fiscal policy spend at a time when the Federal Reserve is trying to bring inflation down. And those types of phenomena, that kind of fiscal spending normally is contracting when we're getting ready to have a recession. That absolutely did not happen last year. We didn't get a recession last year. Fast forward to where we are now, and it looks like everybody's given up on the idea of recession. I think I'm here to tell you tonight that we don't think at T. Rowe Price, my firm, that we get a recession as long as the Federal Reserve cuts interest rates. I'll explain that along the way. So we're going to talk about interest rates. We're going to talk about the Federal Reserve. We're going to talk about the stock market. And we also want to address questions that you have because there is a lot going on. The United States is no longer the world's policeman, and ships are not having an easy time getting through the Red Sea. Meanwhile, if you were running the Maersk line and you had container ships and you're trying to get through the Panama Canal, right now there's a drought in that part of Southern or South America. That drought means the Panama Canal is not operating very well. If you were an enterprising Maersk operator of one of those big container ships, a couple of years back, if you wanted to grease the palms of whoever's running the Panama Canal and jump the line, it would have cost about $500,000. Today, it costs $4 million. So the world's changing. Things are coming back to the U.S. I guess the good news is the American labor that got left behind in that world of peak globalization, American labor now has muscle. But American labor has muscle, but there's also something else that's happening. Something that I'm going to talk a bit about tonight is generative AI, artificial intelligence. It is a big deal. It's only the first inning. And there are a series of startups. There's a whole bunch of money that's going to get spent on the AI world. And right now, the American labor has muscle like they haven't had since the 1970s. But generative AI and the productivity that it brings, they are aiming for $20 an hour jobs here in the U.S. Whether they're successful or not, we'll start to know in 2026, 2027. So that's just a quick, I guess, appetizer in terms of things I'm going to talk about in this quick walk around the world where there's investment opportunity and where it's important to be working with a good financial advisor like the partner that you're working with here, because there are many reasons for us to want to just put our money under a mattress because there's a lot of things to worry about. There's the war, Russia versus Ukraine. We had a global pandemic. But I'm just going to go ahead and give a statistic that's still blows my mind because the stock market is an all-time record high. And I think about the world as it was March 23rd, 2020. That was the market had just dropped 35%. It was the beginning of the pandemic. I myself that year almost died from COVID that year. Somehow I got through, and I'm very glad to be here tonight. But I start my conversation here in that there was a lot of reasons to just run and hide in that spring of 2020. But I wrote the number down. The total return of the S&P 500 since March 23rd of 2020 is 131%. That means it equates to a 24% per year annualized return. We had a global pandemic. Global economy practically stopped. Oil prices went to zero. Russia invades Ukraine. All of that has happened. We have unrest in the Middle East, and the market's still unbelievably up 131%. Part of my message today is stay invested, stay diversified, because things can happen and big moments happen in the market that generate enormous total return. Such a moment happened in December of last year, where again, people are worried about recession. People were worried about the impact of Federal Reserve monetary policy. But the last 2 months of last year was just a rip-roaring end to this 131% return in the S&P 500 since March 23rd, 2020. But that's past. We're here to talk about present and where we go from here. And with that, let's go ahead and dive into this conversation. And please, if you have questions along the way, I think there's a chat feature that you have a chance to input questions and want to have your input and make this an engaging conversation. But if we can move to the next slide, please. Oh, look, there's a lot of words on this page. I want to focus here on the left-hand side and just want to talk about the third bullet point, where there's this talk, and I'm sure everybody's reading the financial news, and there's talk of a soft landing here in the U.S. Like, what does that mean? Well, what it means is everybody's worried about a recession in the U.S. And a technical definition of a recession in the U.S. is 2 consecutive quarters of negative GDP growth is the technical definition of a recession. That doesn't sound so harmful in and of itself, but what it means for the stock market is that in an environment where the economy isn't growing and it's 2 quarters in a row of negative growth, and maybe 2 quarters extends into something more, that means it's hard to generate earnings. And right now, the market is trading at what they call a 21 times multiple. Price to earnings ratio of the market right now is 21 times. So the market at 4,800 points right now. And there's this aggregate earnings number that encapsulates everything in the S&P 500. Right now, that number is about 220. If you take that 220 and multiply it by 21, that gets you to 4,800 on the stock market. If there's a recession, that 220 number shrinks. And then people get worried about the multiple. And if you do some quick math, you could see downside to the market to the tune of 3,700 relative to the 4,800 of where we are now. So whether we have a recession or not, it matters. It's going to matter that the Fed cuts interest rates this year. So this bottom bullet point on the left-hand side, based on a tenuous soft economic landing, and right now overly restrictive Federal Reserve monetary policy, my firm is expecting the Fed to be cutting interest rates at least 3 times this year, possibly as many 6, maybe even more this year. That should keep us out of a recession, which keeps the stock market going. But that's the big question for this year. If we can move to the next slide, please. So let's talk about the economy. And look, if you're anything like me, it takes a really good economist to keep me interested in talking about the economy. It's complicated. It can be mind-numbing. So I guess for me, a couple of things in terms of simplifying this conversation is to break the economy into 2 pieces. So one would be the economy makes things. That's manufacturing. But then there's also the service economy. So that's people who are working in hotels, restaurants, house cleaners, you name it, plumbers coming to your house to conduct maintenance within your home, all part of the service economy. So the economy isn't just manufacturing, but I have found, look, I'm 18 years at T. Rowe, I'm 30 years in the business, and my industry focuses a lot on manufacturing production. Well, what you see on the left-hand side, and let's just focus on the US here, because there's this magic number 50, and we've made it a red line here. And then you can break out manufacturing activity, and you can break out the service economy activity. If you are below the number 50, then that's history tells you that normally the economy is heading for a recession, which means earnings are a problem in the S&P 500, and then that creates nervousness in the market. But notice manufacturing is kind of on this line of 50, But then notice ISM services on the US. Right now it's 52 and change, which is above that line. So it's not a robust economy, but it's economy growing in the range of 2%. And that's enough to keep us out of the recession category. And if you leave the US on the left-hand side and then step outside the US and think about the global economy, manufacturing, borderline recession, but service economy still plodding along well enough. Look, this is all good enough to keep this party going of attractive stock market returns. Now, let me be clear. That 130% total return of the S&P 500 that has happened since March 23rd, 2020, we're not going to get that back. There's a book called Stocks for the Long Run by Dr. Jeremy Siegel. Great read. I always go back to it to just remind myself about what they call investment gravity. Jeremy Siegel did a study of stock market returns more than 100 years and informs us as readers to expect about 6 to 8, potentially 10% of returns in the stock market. What did I just say has happened since March 23rd, 2020? 130%, 24% annualized. We are not going to keep that going. But from my firm's perspective, especially in a world where you got generative AI, which is revolutionary, this makes me think of the 1920s. Makes me think of the 1920s because 1920s, the Roaring 20s, it didn't start until there was the pandemic of 1918, and then things happened in World War I, and a lot of innovation that came at the end of World War I set off the Roaring 20s and the invention of radio and a lot of different things, urbanization. Well, fast forward to where we are now. We just had a pandemic. You have this generative AI, which could be this enormous production machine that just sends us and keeps this trajectory of the U.S. economy going. Anyway, it's just a fascinating time here. But right now, from a traditional economic perspective, recession doesn't look like it's going to happen, but the Federal Reserve does need to cut interest rates. Let's move to the next slide, please. So there's some good news in what is a bad news economic story in China. Let me explain. So T. Rowe Price, my firm, we're a $1.4 trillion asset manager. And years ago, we were looking at the promise of Asia. We were looking at the promise of China. And this precedes the geopolitical tension that's happened in the past couple of years. But we have an investment office in Shanghai, and we have boots on the ground. We know what's happening in the Chinese economy. Well, an enormous build out, urbanization wise, of the year 2000 into 2010, that then shifted into this big housing boom in China. Began with the big cities that were manufacturing hubs, expanded outward. Well, big companies, Country Garden, Evergrande, these are big Chinese housing companies, and they are all absolutely on the brink of collapse. Some have already declared bankruptcy. So think about the housing crisis of the United States, 2006 into the global financial crisis of 2008. Multiply it by 100, put it on steroids, and that's happening in China right now. They overbuilt the real estate. And there's something else that happened in China. As they went inland, if you're a mayor in a smaller city in China and you're trying to keep up with your neighbor right down the road, you were selling your land to property developers, taking that money to build out your infrastructure as China was expanding and trying to build a middle class. That whole story is completely over, and you have strapped municipalities, consumers that are scared. And why am I talking about this? I'm talking about this in that China has a big impact on the global economy, and we've had a problem with inflation since the global pandemic. But China having a problem has actually created a deflationary pulse that happened last year. I don't know how closely people follow the oil market, but WTI oil was $100 June of last year, and now it's hovering in the range of 70. That move has everything to do with China. That move allows inflation to drop here in the US. And if that didn't happen, I wouldn't be here tonight talking about the Fed needing to cut interest rates. But because of China, financial conditions from a global perspective actually eased here over on the left-hand side. And then you see that right-hand side, the New York Fed recession probability indicator that was trending way upward as we got to last summer. Because of things that happened in China and inflation kind of going away, and then some capital investment, this reshoring, onshoring, friendshoring, all that outsourcing that's happened over the past 30 years, all coming back to the U.S., all those things kept the lights on in the U.S. economy. And now you get China slowing down, and you get a Fed that's getting ready to cut interest rates. And you see that the almost shoe-in chance of a recession that was supposed to happen last year, it didn't. And it looks like if the Fed cuts interest rates this year, we're not going to get it this year either. So I get a little nervous here, and I'm just going to pause here for a second when I start talking fast because I get excited about the subject matter. But I know if I'm talking fast, and I wish we were live so I could see all of you, but I would pause here just to see if there's any questions before we keep going, or to just check in to see if there's been any questions submitted here, just to take a second here as I'm blasting through a view around the world. Let me pause and just see if anybody has any questions before we keep going. So let's keep going. If we can move to the next slide, please. So Murray had mentioned, designed by Apple. Here's my smartphone. Sent all over the world. Used to cost us $10,000 at Radio Shack for everything in our phone today. All that's coming back to the US. One of the hottest economies in the world is the middle of the United States, with manufacturing plants getting built again here in the US. Good news for the American worker that got left behind the past 30 years. So this is happening. And I guess I'll just share a side story. My firm, we're known for fundamental research. We have 200 research analysts that cover the globe, and they do trips to see different parts of companies that are in the S&P 500. So we'll just call them industrial companies. Our team did a trip last year, met with a bunch of industrial companies. So think about Ingersoll Rand, think about Caterpillar, think about companies like that. Our team came back from that trip, and they said that of the companies that they met who have operations in China, 100% of them have contingency plans to be moving out of China from a manufacturing standpoint. It's going to take time. They will leave some manufacturing there in China to serve markets that they are still continuing to serve there. But other than that, it's coming back to the US. That's happening from what we call a bottom-up perspective. But there's also industrial policy here in the US. And you're going to see the CHIPS Act, the IRA, that's the Inflation Reduction Act. This is fiscal policy that is spending money on building manufacturing infrastructure here in the US. Normally at this stage of the economic cycle, you are not getting a big lift here from this type of economic activity, but you're absolutely getting it now. And this is one of the main reasons why the US economy did not have a recession last year. This phenomenon continues to happen, and it's one of the reasons why the economy still can grow at 2%, even though the Federal Reserve took Fed funds from nothing beginning in 2022 to now 5.25%. And we are still chugging along. This story here has a lot to do with that. If we move to the next slide, please. So I've mentioned the American worker, designed by Apple, sent all over the world, outsourcing. So let's leave Apple. Why don't we talk about Nike and think about it the same way? So what you're seeing is excess supply of workers, excess demand of workers as we survey corporate America. This whole environment of peak globalization very much happened in the late 90s into the early 2000s. And that's that big green wave of under demand for the American worker. Let's fast forward to the right-hand side. And there's that blue small hill over on the right-hand side. American worker right now is making more than $20 an hour. There's a shortage of jobs, and the unemployment rate is 3.7% because of this construct that I'm talking about. American worker and wages are growing at 5% a year, which is keeping inflation a little bit elevated here. Artificial intelligence, generative AI, is targeting these $20 an hour jobs, and robotics and automation will be part of this excess demand for American workers. But this doesn't happen for years. Right now, American labor is in the driver's seat. If we please move forward. And the pandemic happened. Oil prices went to nothing in the spring of 2020, and now they're $70 a barrel. A lot has happened. But when the global economy shuts down, goods and the price of goods went way up. Remember how expensive it was to get products from Clorox, not enough rubber gloves. My wife's girlfriend sells Ford trucks in the state of Florida that were selling for $120,000 a clip. If you wanted a G-Wagon from Mercedes during this moment of the pandemic and you had to have the truck, $300,000, $100,000 over sticker, that was where we were. We're not there anymore. But notice this big massive inflation, goods inflation, where we were during the pandemic. That has really come down. And what's left is higher rents, and labor is where the inflation is. But we've come from 9% inflation down to 3.2. We've come a long way. And because of that story in China, which is a dampening effect on global demand with oil prices, not $100, $70. All of that has now inflation in the 3% range, not 9% inflation. We've come a long way here, and this is a good news story, and this allows an opportunity for the Fed to be cutting interest rates this year. If we please move forward. So one thing about the U.S. economy, and where, from my perspective, 18 years at T. Rowe, 30 years in the business, and there's a lot of talk about recessions that hardly ever happen. Well, this slide that we're looking at essentially breaks the economy down into 5 major components. And I'm sorry for the tiny font, but you're going to see manufacturing, you're going to see consumer, you're going to see labor, you're going to see housing, and then there's going to be an other bucket. Our economy is the best economy in the world. It's diversified. And when one part of the economy isn't working, another part of the economy can be working. It's what they call a rolling recession. There can be parts of the U.S. economy. So if you stay with me on this visual and you look at the months of May into July of 2022, and you're going to see that pale blue, baby blue, and it's going to be negative. And if you look at that, that is the consumer, that is housing. Those are classic parts of the U.S. economy that were negative. That should have took the U.S. economy into recession. And if you stick with me on the 2 bars, it lasted 2 quarters in a row. But notice what was above the zero line. You're going to see the navy blue, and that was manufacturing, which has everything to do with this new world order for manufacturing. And you're going to see the other component, which is companies that are bringing manufacturing back to the U.S. That stuff was working while classic parts of the U.S. economy were not. I guess what I'm here to say is the U.S. economy is quite diverse, and you can have a rolling recession and not actually have a recession. And that's sort of the story for the U.S. economy right now. It's diversity. It's the best economy in the world. And go U.S. from T. Rowe Price's perspective. If we please move forward. I mentioned at the outset of there can be a lot of bad news going on in the world, and there is a lot of bad news going on in the world. But there is also, in the investment management industry, there's also the Federal Reserve. There are also, in their heart of hearts, Washington, D.C., they're trying to do their best for the United States. I guess where I'm going with this is we can get caught up in a bad story narrative and get surprised by some positive good news. That happened late last year. Everybody was worried that the United States government borrowing too much money, and they are, and it's a $30 trillion national debt, and it's a problem here at some point. But Janet Yellen at the Department of Treasury was able to give a schedule of how the U.S. Treasury is going to fund itself in 2024. And it took a lot of worry out of the market late last year while inflation was happening. And that was enough. And then meanwhile, Jerome Powell, managing the Federal Reserve, he gave an indication that they could be thinking about cutting interest rates in 2024. And what you ended up with from October 31st through December 31st last year was one of the biggest, they call it cross asset rallies, that's happened in the past 40 years. And if we're just picking up the paper and picking through negative news stories, and if you weren't invested, you would have missed what just happened. But this benefited S&P 500. It benefited U.S. Treasuries. It benefited international stocks. And I haven't mentioned it yet, but the stock market was up 20% plus last year. 70% of that return was generated by the stocks called the Magnificent Seven. I'm hoping everybody on the call is familiar with them. This is your Apple, your Amazon, your Meta platforms, your Tesla. Those companies, they generated 70% of the return. So the Magnificent Seven was part of this story, but it was just besides the Magnificent Seven, it was a big lift for risk assets overall. If we move to the next slide, please. And so before I go another step further, is anybody interested on what the future may be for the 10-year U.S. Treasury yield, or when the Fed's going to be cutting interest rates? Let me pause on the topic and just see if that generates any questions or interest. I'll pause for a second. So I'm not hearing anything. And let me just get to monetary policy here. There is a $30 trillion deficit in the United States. That is just a bunch of demand that's going to generate a bunch of U.S. Treasury issuance. Remember, I mentioned at the outset of this call, Russia invades Ukraine. Half the world doesn't condemn the action. That half of the world used to buy U.S. Treasuries, and they're not buying U.S. Treasuries anymore. So there's a lot of worry about Treasury yields and what was going to happen last year. 10-year Treasury yield got as high as 5% last summer. Today, we're hovering just above, we're in the 4.10% range. And I think from my firm's perspective, with inflation dropping, Fed potentially cutting interest rates, and we think the first cut could actually happen in March. 10-year Treasury yield, we're expecting to be hovering in the range of 3.75 to 4.25%. We are expecting the Fed to cut interest rates in March. How far they go is going to have everything to do with inflation that's been dropping. But what did I also mention? Ships aren't going through the Red Sea anymore. They now have to go around the Cape of Good Hope around South Africa. There's a problem in the Panama Canal. Shipping costs are skyrocketing. So there's this big deflationary story allowing the Fed to cut interest rates, but globalization and the flow of goods right now, there are challenges to it. So this is an interesting story that's going to be playing out this year. But for now, 10-year Treasury yield, 3.75, 4.25%. Fed starts cutting interest rates, and hopefully the geopolitics settle down a little bit here. If we please move forward. I mentioned United States, $30 trillion deficit. We're running an annual $2 trillion deficit. There's going to be a problem here at some point. Debt to GDP in the United States, we're at a point where it was coming out of World War II, but except we didn't have the World War. But for right now, the global financial system is handling this, but there is a lot of Treasury issuance coming through the market. And even though the Fed's going to be cutting interest rates, the 10-year Treasury yield at 4.10%, it may not be moving that much downward with what the Fed's about to do, which makes it a really interesting time in my line of work in covering global fixed income. If we please move forward. So I don't know if anybody's familiar or remembers Paul Volcker. He was a Federal Reserve chairman when I was in high school. So I graduated from high school in 1981. And my dad was a great man. And now I sort of know why he was stressed out a lot. Well, because the Fed funds rate was 19% and there was a problem with inflation. There's a problem with inflation because there was two energy shocks in the 1970s, 1973, 1977. There's a gentleman named Arthur Burns who had monetary policy, in charge of monetary policy in the 1970s. And that's that navy blue line is part of the time of Arthur Burns. Arthur Burns had monetary policy at 12% in 1974, and something called the Nifty 50 was absolutely collapsing. And you could argue that Arthur Burns caved into political pressure and cut the Fed funds rate prematurely. Yet another energy shock in 1977, and nobody remembers Arthur Burns, but everybody remembers Paul Volcker. So I guess where I'm going with this is inflation is a bit of a question. Fed's going to be cutting interest rates, but there's this history from the 1970s that may keep the Federal Reserve from being too aggressive. Now, here's one big difference from today versus the 1970s. The United States is energy independent, and technology is a big deal. And even artificial intelligence is helping efficiency in terms of output from an oil perspective here in the U.S. So while Arthur Burns is part of the story here, why the Fed may not be cutting interest rates aggressively this year, I think the fact that the U.S. is energy independent, I'm with the T. Rowe Price economist that thinks the Fed's going to be cutting interest rates at least 6 times this year because it's not the 1970s all over again. If we please move forward. Remember I mentioned China and how bad the economic story here, or the economic story is there right now? I just put a visual on the left-hand side to just bring up D.R. Horton, a well-known U.S. home builder, has had a great run coming out of the pandemic. And then there's one of these big Chinese property developers, Country Garden, is flirting with zero and potentially on its way to bankruptcy. It's this real estate crash in China has their economy, and they're putting up a 5% growth number, but it's not a 5% growth number and an economy operating the United States the way the United States economy works. And it's not a consumer story that's driving demand for oil, which has oil not $100, $70. So China, not a great grower here, but representing an opportunity of bringing inflation down when inflation was a real problem coming out of the pandemic. If we move forward, please. So let's give policymakers in the United States and the rest of the world credit for what they did in the spring of 2020. Remember what I said, the S&P 500 is up 130% since March 23rd, 2020. Would that have been possible unless policymakers had done some absolutely extraordinary revolutionary things? It wouldn't be. But here, part of what they did is they pumped $25 trillion of stimulus into the global financial system, just an enormous amount of capital, never been done in financial history before, and it created inflation. And I bring this up in that the rest of the world reacted to this before the United States did, which I'm giving you a global view of the global interest rate cycle. I'll just hit a couple of examples here because we could get lost in this conversation. But let me just get to my punchline. And it's tiny font on the left-hand side. And you're going to notice on the left-hand side, Brazil, right next to Hungary, up in the upper left, their policy rate got as high as 13.75%. It started at 2%, got as high as 13.75%. Well, today it's 11.25%. Chile, down in South America, their policy rate got as high as 11.25%. Now it is 8.75%. The developing world was first to react to inflation that came as a byproduct of policy out of the pandemic. And the developing world is parts of it, or they're the first ones to be cutting interest rates. This just means being globally diversified, not forgetting your fixed income, even though the equity market's been on a tear, working with your financial advisor to be globally diversified and have some global fixed income makes a lot of sense here. And global diversification, everything shouldn't be riding on the Fed here, because now you have monetary policy cycles that are running at a different cadence relative to the past where it all kind of ran together. If we please move forward. And this is just a close-up look of what I said about Brazil, where the policy rate went almost out to 14% and then dropping. Chile dropping, and here's the Fed stuck at 5.25%. And again, T. Rowe Price, our economist, thinks that with inflation coming down, with the bad Chinese economic story, that the Fed is in line to be cutting interest rates 3 to 6 times, and she's leaning on 6. Most of our portfolio managers aren't buying that. I'm with our economist. Her hit rate is about 70% on her calls, but it's just an interesting time, and interest rates being cut by other parts of the developing world sort of help the Fed story here. Please move forward. And let's move forward. Credit markets in the United States are working very well. And this is a spread analysis. This is just the extra yield that you get from below investment grade companies versus equivalent maturity US Treasuries. That pale blue line tells you the average spread, the average extra yield that you get in high yield versus US Treasuries. And we're below that line, which means that high yield markets, credit markets, in my line of work, they call it tight. Not a lot of room for error here. But while credit markets are tight, credit markets are open. Does everybody remember the regional bank crisis of last spring? Federal Reserve, Silicon Valley Bank, First Republic Bank. Let's also give the Federal Reserve credit because it was looking like a regional bank crisis in the U.S. It makes me think of, if anybody remembers the Child's Tale, the little Dutch boy saved Holland. There was a hole in the dike and he put his finger in the dike. I think of the regional bank crisis, and there were 8 holes in the dike, and the Federal Reserve took all 10 of their fingers and they plugged the gap. I guess where I'm going with this is credit markets are working, and PNC Bank came to market last week with a couple of $1 billion that was well received. That paved the way for more regional banks to issue debt. If that's the case, regional bank crisis isn't a crisis anymore. It's actually working, meaning there's a lot of things to be worried about, but there's a lot of things that are still working right, and credit markets are one of them. If we please move forward. Remember I mentioned there is an environmental consideration problem in the Panama Canal. So you see my text up in the upper right-hand side, the Panama Canal has gotten so dry and backed up after the brutal drought. Shippers are paying up to $4 million to jump the queue. These aren't my words. This is Fortune magazine, early December of last year. It's also geopolitics involved here. If global supply chains are getting reconfigured and we haven't brought the manufacturing back, this has grave implications for the Ukraine, where it may take years to get Stinger missiles on the ready to help Ukraine in its fight against Russia. Just global supply pressure is back. Peak globalization is gone, and the world is figuring it out right now. If you please move forward. And let's move forward. And we're just about done here. So a globally diversified portfolio at T. Rowe Price, this is the world of what they call multi-asset. And you're going to see a gray bars right in the middle, which is what we call neutral. And then you're going to see red to the left, green to the right. So there's different parts of the market that we like more than being neutral. So you're going to notice that Japan, up in the upper left-hand side, we like Japanese equities. Japanese equities, they're going through a corporate reform story, and it's a dirt cheap Japanese yen. And Japan is actually doing a lot of work with China from an automation robotic standpoint. So we like Japan as an example. Credit markets, I said they're operating, they're working really well. You're going to notice over in the lower right-hand side that we are overweight global high yield, what they call floating rate loans, which is below investment grade credit that has a floating rate coupon. And we like emerging market debt. Remember that story that I said, or that I showed you, that Brazil's policy rate was 13.75%. And now it's 11.25%. From a fixed income perspective, when somebody's cutting interest rates, that provides a powerful total return. So we like emerging market debt down the lower right-hand side. And global diversification, yes. Having technology in your portfolio, absolutely. But something else with this whole world order being reconstructed, manufacturing coming back to the United States, you're going to notice up in the upper right-hand side, U.S. small cap versus large cap. Having some small mid-cap exposure in a portfolio makes a ton of sense. That part of the world will be a beneficiary of this new world order where supply chains are getting consolidated and good old-fashioned manufacturing has come back to the United States. I know when I'm out of breath, it's time to stop talking. I wish we were live because I'd love to be having a conversation that way. Really hard to read a room when I can only see a couple of faces. I'm going to stop here. I hope there's some questions. I appreciate the time.
Thank you, Chris. That was fantastic. If you do have some questions, we do have a few minutes open here to take some questions. You can type them into the chat and we can go over those. We'll leave that open here for a minute and see if anybody has anything they'd like to hit on. Just type them into the chat and we'll go over those.
And you told me 40 minutes and it's 7:40.
There you go. Look at that.
I'm on the East Coast. That's why it's 7:40.
Well, as we're waiting to see if any questions come in, I'll just go over the next event we have coming up will be Wills and Trusts. Oh, looks like we got something here.
Thanks for the question.
Chris, can you see that? I'll just read it out loud. How does the presidential election factor into your outlook?
So I want to say that it does not, but I say that at the same time that investment meetings that I attend, the election comes up in every meeting. So it's on our minds and really difficult to think about who's going to win the election. It's a coin flip. Oh, nothing good to say about, nothing good or bad to say about either candidate, other than typically during an election year, there is interest in keeping the economy going and keeping things going well for the incumbent administration. So history tells us that normally an election year is good from a Federal Reserve monetary policy standpoint. And I'm here talking about the Federal Reserve cutting interest rates. Federal Reserve's cutting interest rates keeps the U.S. economy out of recession. This allows the S&P 500 to keep chugging along. So while my company doesn't directly address the election and its impact on markets, history tells us that election years are normally friendly from an economic and investing perspective. I appreciate the question.
We've got another question here. In the last slide, can you explain the red and green colors on the last slide you had, the range there?
Thank you for the question. So in multi-asset at T. Rowe, so this is $440 billion of my firm's $1.4 trillion in assets. And T. Rowe Price, we're known for target date funds, retirement date funds. So somebody in a 401k and they don't want to follow the stock market the way I do, and you just want to have a globally diversified portfolio, you give it over to T. Rowe Price and you put into a target date fund that has a maturity that matches your time horizon until you're retired. So we, in that world of retirement savings, we are invested all over the world. And when we're invested all over the world, we think of the stock market from a long-term perspective. So call it, 30 or 40 years. And that means we're going to be 60% global stocks. We're going to be 40% global fixed income. But there are things that happen in markets from a 12 to 18 month, even a 6-month perspective that are going to impact different parts of this globally diversified portfolio that we want to take advantage of. So we're invested in all of this stuff that's on the screen, but sometimes there are things that happen that we like something better than something else. So remember when I said manufacturing is coming back to the United States, and this is going to be beneficial to small cap companies, mid cap companies in the United States. So if you move to the upper right-hand side, you're going to see US small cap versus large cap. Look, we're already invested in small caps and large caps, but right now with large caps and with the Magnificent Seven in large cap growth doing so well last year, a normal multiple for the market, an average multiple going back to 1950s, is 15 and a half times. Right now, the multiple for they call the Magnificent Seven stocks, these stocks, big seven tech stocks, Apple, Tesla, NVIDIA, Google, Meta, we know these names. The multiple for those stocks right now is about 40 times. They're expensive. There's a lot of good news baked in. You want it in your portfolio. But there's also this story of mid-cap companies that are absolutely dirt cheap that we think are going to perform better over the next 12 to 18 months. So we are going to tilt our investment a little bit to small caps versus large caps at this moment in time. So the green is overweight, gray is neutral, and then something that we are underweight is right now, think about Europe, and you have a war, Russia, Ukraine. You have China economy not working very well, and you have Germany not exporting Mercedes-Benz to China, meaning U.S. economy is growing about 2%. Europe's economy is growing about 0.5%. So we are underweight European stocks. So you'll see that Europe, it's not quite red, but it's pink, meaning we're not liking Europe here so much. Japan we like, small caps we like, and I hope I answered the question.
There's another question I'll come back to. I think you kind of covered that a little bit, but there's one other one here. If I can get in there. Is there any one factor that would change your generally positive attitude for the next 12 months?
What would change my attitude would be the last 9 months have been a really great trend from an inflation standpoint. Look, we had inflation in the 9% range that's now 3.2%. And if you do further math on inflation right now, it's something they call core PCE, personal consumption expenditure. That's what the Federal Reserve focuses on. From a 6-month perspective, annualized, so I don't want to get too deep into the math here, but right now that's running around 2%, which is the Fed's target. And it allows me to say that Federal Reserve policy is too tight and the Fed needs to be cutting interest rates. If the Red Sea conflict is a problem and there's no fix to the Panama Canal and inflation starts going the other way, my generally positive demeanor this evening would be quite different, and there's a very different outcome. Nobody is talking about now the Federal Reserve actually having to hike interest rates more than where they are. If that were to happen, this is when a globally diversified portfolio and making sure all of your eggs aren't in one basket. But if you get inflation going the other way and the Federal Reserve actually had to raise interest rates again, that would absolutely change my tone on this call. Absolutely. And not in a good way.
And I think this is the last one I'm seeing here, and I think we've covered some of this, but question on investing in the Magnificent Seven. How much exposure should I have and what is the risk?
I'm trying to think of how to frame this. So let me put it this way. I'm just thinking of the math. So a globally diversified portfolio is 60% global equities. It's 40% global fixed income. So let's move away from that and let's just think about your stocks as a 100% portfolio. T. Rowe Price in a globally diversified portfolio, the way we set it up is we're 70% US and we're 30% international. That's our neutral, our normal. So of that 70% in the US, let's make that 70% US and let's make that 100%. We're about 50% value or 50% growth. So I guess I'm doing the math here. From our perspective, you're going to want to have at least 30% of your portfolio in growth-oriented investments. But here's the thing. It's not the Magnificent Seven that you need to have right now, because now there are major cracks in Tesla. You want to have NVIDIA. You want to have Microsoft. But the next dimension of this is you're going to want to have software stocks, because that's the next evolution of this strategy. So I just don't think of it so much as the Magnificent Seven, as think about it as growth equities, and at least 30% of your portfolio should be there.
And then there's a follow-up to that. Whoa, somebody just put a long one in. Hold on one second. I'll go to Kyle French here, one of our other advisors. S&P 500 is currently reporting a year-to-year earnings decline of around 1.7% for Q4 23, which would be the fourth year-over-year earnings decline for the index in the past 5 quarters. With a 21 times PE well above the 5 and 10-year average and earnings stuck moving sideways, do you believe earnings will move higher or multiples will continue to go up?
Love the question. I hope we didn't leave the rest of the group, but love the question. There's a good news story. There's a bad news story here. But let me just get to the good news part of this. Absolutely correct in the premise of the question that we've already had what they call an earnings recession. There's this aggregate earnings number in the S&P 500, and it's been stuck on 220 for 18 months. Like, that number dropped as low as 132 during the darkest days of the pandemic, and it recovered all the way to 200, and now we've been stuck kind of on 220. The expectation from the market's perspective is that number is going to grow by 10 to 12% this year, meaning that aggregate number, 220, is going to be 245 by the end of this year. If you don't get that earnings number, the market multiple just becomes more expensive because you don't have earnings behind it. So I guess in terms of the question, from T. Rowe Price's perspective, last year it was artificial intelligence and generative AI. And the market multiple was about 17 times when that story hit the market. And now we have a 20 times multiple, 21 times multiple, and earnings haven't followed. Here's the thing, and the timing of the question is a little bit tough. If the Federal Reserve is cutting interest rates here and we avoid recession, T. Rowe Price believes we make the 240 number on the earnings. So we think that happens. I think the multiple is flatlined here at 21 times. If earnings don't follow here, there's going to be a problem in the market. But this is going to be a 2025, 2026 question, because here's the thing. From my firm's perspective, generative AI and the amount of money that's about to get spent is going to be nothing short of earth-shattering. It's going to be maybe $3 trillion in the next 3 or 4 years, which is the size of the United Kingdom's economy. Broadcom, working with Meta Platforms, there's a $10 billion investment from Meta Platforms for semiconductor chips that Broadcom makes. This is just one little piece of the story. And I guess I just wrote this down in terms of AI things and developments that are going to be coming that are going to make the multiple story interesting and make margins interesting. And it's ad search recommendations. It's Broadcom working with Meta Platforms, $7 to $10 billion spend in terms of GPU, general processing, just advanced math, just coming from that part of the world. Life sciences using generative AI to produce better outcomes. It used to be machine learning. Now it's generative AI. This is going to be big from a healthcare perspective. If you're Tesla or you're Ford and you're thinking about building a manufacturing plant, you're not going to be able to simulate that exercise in an AI format before you even spend $1 on the plant. Cybersecurity. You're going to get attacks from an AI perspective, and you're going to need AI to fight it. There's an AI in the arms race, and it's the first inning, and this is a big deal. Now, this isn't going to have a big impact on the market this year, but for 2025 and beyond, holy cow, there are big things happening.
Think I got them all? Yeah, I do not see any. Oh,
And for anybody with
yeah, I think
kids
we're all.
out there, and for anybody with kids out there, if we're right about this AI phenomenon and it chasing jobs for this labor shortage that we have, don't forget your trade schools. We're always going to need plumbers and electricians. Like, so anyway, I digress. And that was a personal comment, not a T. Rowe Price comment.
All right, with that, I think we'll wrap this up. I'd just like to do a couple little notes here. Our next event will be Wills and Trust webinar on Wednesday, February 21st. We will send clients an email that you'll get details on this, and we'll open registration up for that shortly. We also welcome feedback from everyone about our events, so please reach out to your advisor or email us at info@wdstrategies.com. Let us know how we're doing or some topics we'd like to see covered. Again, I'd really like to thank Chris Dillon and T. Rowe Price for putting on the presentation tonight. And again, thank you everyone for joining. We hope to see you at the next meeting. Have a great night, everyone. Enjoy the rest of your night.
Be well. Thanks, everybody. Have a great year.